Welcome to video 7B on capital gains and losses. As we should have learned in our planning variables, we know that character counts. And when we think about individuals of high character, well, okay, not everyone, we really need to think about character as it relates to taxes. So we know that ordinary rates for individuals are from 10 to 37%. But long-term capital gains rates are preferential and can be 0, 15, or 20%, like we just saw in the last video as it relates to qualified dividends. So as a result, capital treatment for gains is generally preferable to ordinary treatment. So the default general rule is that gains and losses are ordinary. Capital gains and losses generally come from the sale of capital assets. Now, there are a bunch of exceptions, and some of these we cover in here, like 1231, 1245, and 1250. However, the unrecaptured 1250 and the collectibles, that's left for 503. We don't really cover that in here. When we get to the corporate chapter, we'll cover section 291. All right, so what is a capital asset? The capital asset is anything that is not a capital asset. Yes, it's defined using a double negative. So qualification as a capital asset can depend in part on the purpose for which the taxpayer uses the assets. However, both individual and corporate taxpayers generally prefer capital gains to ordinary income. So here's the list of items provided in section 1221 as to what is not a capital asset. So inventory. So the sale of inventory, therefore, would generate ordinary income. The sale of trade or business property. The sale of accounts or notes receivable acquired in the ordinary course of a trade or business. And then a few other things that we really don't spend a lot of time on. So ordinary assets are kind of by default everything else, right? So assets created or used in taxpayer's trade or business, that was on the not a capital asset list, making that an ordinary asset. Business property held for less than a year. So inventory, accounts receivable, machinery and equipment, these are all ordinary assets. If a taxpayer sells ordinary assets at a gain, they recognize an ordinary gain. That would be taxed at ordinary rates. If they sell ordinary assets at a loss, they deduct the loss against other ordinary income. So here is a nice chart that kind of shows the breakdown of the different kinds of property and what kind of gains or losses might be generated. And we're going to defer 1231 until a later chapter. But we're largely going to talk about these other things with a focus on investment or personal use assets. Okay, so here is another great chart that really summarizes some of the rules that apply to capital gains and losses. So let's start with individuals who can have their capital gains taxed at 15% or 0% or 20%, as we know. Now, we're not going to worry about these items. These relate to 503 only. We're just going to ignore them. However, look, under corporations, there are no preferential rates for capital gains and losses. They are simply taxed at regular corporate ordinary rates. From a loss limitation perspective, individuals can deduct up to $3,000 of a net capital loss against their ordinary income. And to the extent they're unable to deduct, they have more than that and they're unable to deduct it, they can carry forward that loss indefinitely. Corporations cannot offset any amount of net capital loss against ordinary income, but they can carry it back 3 years or forward 5 to try to offset capital gains in those years. Okay, so let's recall the character planning variable. Deductions are worth more at higher marginal tax rates. And we'd rather pay lower marginal tax rates on income or gains. So let's assume we have a taxpayer with ordinary rates of 35 and long-term capital gains of 15. What kind of gains would that taxpayer want and what kind of losses? Well, let's take a $10,000 gain. So if we applied ordinary rates, they pay taxes of $3,500. If we pay capital gains rates, they only pay taxes of $1,500. So clearly, in the gain situation, we prefer capital treatment. If that's a $10,000 loss, the tax savings we derive from that deduction is $3,500, whereas at capital gains rates, it would only be $1,000, because remember, we'd only get a small portion of that, the $3,000, and we'd offset that against our income. If it's a corporate taxpayer, there's no capital loss benefit at all, except that you can carry it back or forward. So this clearly raises the specter of how important holding period is, right? So again, we have ordinary rates and they're taxed at 35. Long-term capital gains are taxed at 15. But note that short-term capital gains are taxed at the same rate as ordinary income. Now that doesn't make them ordinary income. It simply means they're taxed at the same rate as ordinary income. So holding period becomes important. So long-term means you've held it for more than 1 year. So that means you have to have held it for at least a year and a day. That excludes the date of acquisition, but includes the date of sale. It's based on calendar months, not the number of days. And it's based on the trade date for stocks and securities, as opposed to something called the settlement date. All right. So recall this: amount realized minus adjusted basis equals realized gain or loss, less any deferred or exempt gain or loss is the amount of recognized gain or loss.
Learn it, know it, live it.
Okay, with that in mind, let's talk about some holding period complexities. All right, so let's say we're talking about the acquisition or sale of financial instruments, so investments. And the tax law permits you to use two methods by which to track your inventory in these investments, either specific identification or first in, first out. So let's assume that Mr. Burns purchases 40 shares of the Cheesecake Factory on June 2nd, 2016 for $30 a share.
Oh, and one more thing. You must find the Jade Monkey before the next full moon.
Actually, sir, we found the Jade Monkey. It was in your glove compartment.
And the road maps and ice scraper?
They were in there too, sir.
Excellent.
Then he purchases an additional 60 shares on July 6, 2017 for $35 a share. And then in December of 2017, he sells 30 shares for $33. What is his amount realized, adjusted basis, and realized and recognized gain or loss? Okay, so first, let's start with first in, first out. So the amount realized is the same. It doesn't matter which shares he picks to sell. He sold them, no matter which they are, for $33. So the amount realized is $990. On a first in, first out basis, the first shares he purchased were those in 2016. They were $30 a share. So we take the 30 shares times $30, we get $900. He ends up with a realized and recognized gain or loss of $90, which would be long term, because he's held those shares for more than 1 year.
Ooh, once again, my dear, you've beaten two strapping young bucks.
Excellent.
Did you hear that? That excellent was excellent.
If we do specific identification and we choose the oldest shares, then we're going to get the exact same result, right? Because the oldest shares are first in, first out. If, on the other hand, we choose specific identification and we choose the newest shares, then you can see that actually what happens is our adjusted basis is increased because those shares were purchased for $35 a share. 30 times 35 is 1,050, and Mr. Burns actually ends up with a short-term capital loss of $60 in this situation.
Mr. Burns, we did it! Everyone in the neighborhood sold us their gas rights. Excellent.
So the cap gain loss netting rules are very complex. Again, for those of you that just had me in 503, you know that's the case. And we're not going to cover all of them in this course, but we're going to cover some basic ones. So again, for individuals, net capital losses are limited to $3,000 per year. That's the amount you can offset ordinary income. And that's the same if you're single, married filing joint, head of household, etc. Unused capital losses are carried forward indefinitely. For corporations, net capital losses are only deductible to the extent of capital gains. There's a carry back period for 3 years and then a carry forward for 5 years. And note that there is no preferential rate treatment for corporations and capital gains and losses. Okay, so Bart has the following gains and losses. He has a short-term capital gain of $3,000, a short-term capital loss of $8,000, a long-term capital gain of $3,000, and a long-term capital loss of $12,000. What is the amount and character of Bart's gains or losses for the year? So we're going to apply the simple netting rules, which is we have to net all the short-term against one another and then net all the long-term against one another. So our net short-term is a gain of $5,000. That's the 13 less the 8. Our net long-term is a loss of $9,000. That's the 12 less the 3. We now, since those are of opposite signs, we now net those against one another, and we end up with a net long-term capital loss of $4,000 because the net long-term loss is larger than the net short-term gain. So the big fish swallows the small fish. We end up with a long-term capital loss of $4,000. Now, Bart is an individual, so let's think about how that's going to be treated. He's going to be able to deduct $3,000 of that loss, and then he'll have a carry forward net capital loss of $1,000 so that hopefully he'll generate some capital gains next year to be able to offset that with. If Bart is Bart Corporation, and Bart Corp has the exact same gains and losses, how do we treat that? So we go through the same netting process that we did when Bart was an individual. Net the short term, net the long term. They're of opposite sign, net them together. Now recall that a corporation cannot offset any of its ordinary income. So what this means is even though they've generated a realized long-term capital loss of $4,000, they'll be unable to deduct any of that. They'll have to look back 3 years, see if they have any carryback opportunity, or they can forego the carryback and go ahead and start the carry forward. And when we do the corporate chapter, we'll spend significantly more time on how this works for corporations. Okay, so before we leave this area, there's special rules that apply to the sale of personal use assets. Gains are in fact taxable as capital gains, and losses are not deductible. Capital losses from sales to related persons are not deducted currently. The related person might be subsequently able to deduct all or a portion or maybe even none of the disallowed loss on the related party sale, but that also is a 503 issue. So Gordon Gekko buys 100 shares of Blue Star Airlines on January 3rd, 1995 for $100 a share. And on the last day of 2018, Blue Star's worth only $20 a share. But Gordon wants to hold on to the stock because he expects it to bounce back up. But he comes up with a strategy. He says, you know what, at 9:30 when the market opens, I'm going to purchase 100 additional shares of Blue Star for $20 a share. 1 minute later, I'm going to specifically identify the shares I bought back in 1995 and sell them at the same price. So I'm going to sell and recognize a loss of $80 a share or $8,000. Now let's think about this transaction for a second. Gordon owned 100 shares. He bought 100 more. So for a minute, he owned 200 shares. And then he sold 100 shares and said, under specific ID, those are the old shares. And therefore, he recognized a loss of 8,000. So one of the problems is economically, there's no difference between Gordon before this transaction, these two transactions, and after. He owned 100 shares of Blue Star before. He owned 100 shares of Blue Star after. He engaged in a planning activity known as loss harvesting. Unfortunately, that is not permitted. Under Section 1091, when a taxpayer acquires substantially identical property 30 days before or after the sale of property at a loss, that loss is disallowed. So let's look at Gordon's situation. The amount realized was 100 shares times $20. That's $2,000 amount realized minus his adjusted basis, because he used specific ID, of $10,000. So his realized loss is $8,000. So was that substantially identical securities? Oh yeah, it was the exact same stock. Was it 30 days before or after? As a matter of fact, it was within a day. In fact, it was within a minute. Was it sold at a loss? Yes. As a result, no loss is recognized. So what happens to this loss? Well, it's deferred. And the way it's deferred is that it becomes part of the basis of the substantially identical property purchased. So those new shares that he purchased, 100 shares, not $100, 100 shares times $20 is $2,000, plus he adds to that the $8,000 deferred loss and is right back to his original $10,000 adjusted basis amount. What about the holding period? Well, when you have a wash sale transaction, the holding period does what's known as tax on, which means when he ultimately does sell those new shares, he gets to treat it as if he held them from the date he bought those original shares. So he tax on the holding period. That brings us to the end of video 7B. Thanks for watching.
The new law of evolution in corporate America seems to be survival of the unfittest. Well, in my book, you either do it right or you get eliminated. In the last 7 deals that I've been involved with, there were 2.5 million stockholders who have made a pre-tax profit of $12 billion. Thank you. I am not a destroyer of companies. I am a liberator of them. The point is, ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms. Greed for life, for money, for love, knowledge, has marked the upward surge of mankind, and greed, you mark my words, will not only save Teldar Paper, but that other malfunctioning corporation called the USA. Thank you very much. What the hell do you want?
I just found out about the garage sale down at Blue Star. Why?
Last night I was reading Rudy the story of Winnie the Pooh and the Honey Pot. You know what happened? Stuck his nose in the pot once too often, and he got stuck.
So tell me, Gordon, when does it all end, huh? How many yachts can you water ski behind? How much is enough?
It's not a question of enough, pal. It's a zero-sum game. Somebody wins, somebody loses. Money itself isn't lost or made. It's simply transferred from one perception to another. Like magic.